Good morning, good morning. It is Monday, the 13th of January. This is the morning blast with myself and Mr. Michael Brown. Let me just add him in. Invite Mr. Michael Brown. Send invite. There we go. Let's wait for him to turn up before we do the legals because, as usual, he won't trust that I've done them correctly.
Good morning, Ryan. Good morning, everyone.
Good morning, my dear friend. Let me get the legals out of the way. Nothing discussed in this space session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, Trainers PIQ or PIQ Suite, or its affiliates, including the hosts, which, as you know by now, is Mr. Michael Brown. Way, Mr. Ryan Paisley. Way. Word of warning: our dear friend Zach, who does the overnight news roundup, is on holiday, so I've jumped onto also a good friend and also very excellent morning report that he puts out, Mr. Andrew Hart. So I've taken some headlines from his. So just in case the flow isn't exactly the same because I've pick and mixed from different headlines and stuff like that. So just...
slacking? I mean, holidays in January. We've just had Christmas, for God's sake.
Well, someone's obviously getting paid too much. Not by me.
Well, quite. You know, the young lad. Poor commitment, I must say.
How are you anyway?
I'm very well, mate. I'm very well. Although it is
Good.
bloody cold this morning, and it is
It's bloody
also
freezing.
freezing in this office as well.
Oh, well, I can't help you there, unfortunately.
No, Mr. Rich Bernard will be pleased to know that I am sporting my warmest gilet this morning, just to keep nice and wrapped up.
Financially, they can't. All right, moving on. What's happened?
Indeed, yes, let's crack on. Good morning, everybody. Of course, last week wrapped up with all eyes really on the December US labour market report, and it was a blowout set of employment figures from the United States, with headline non-farm payrolls rising by 256,000 on the month, well above the 165,000 consensus. And actually, I will own up to this, having ridiculed Bloomberg Economics for their non-farm payrolls forecast on Friday morning. They were actually closest to the mark with a guess of 268,000. Nevertheless, that 256,000 payrolls print was the biggest one-month job gain since March of 2024. And although it was accompanied by a net downward revision of 8,000 to the prior 2 months worth of figures, that was not enough to take the shine off the release. Other areas of the labour market report were also quite impressive, with unemployment falling to 4.1% in December, down from the prior 4.2%, and also the consensus estimate of 4.2%, while that came as participation held steady at 62.5%. Meanwhile, earnings point to the labour market not being a source of inflationary pressures, with average hourly earnings having risen by 0.3% on the month, which in turn saw the annual pace dip to 3.9%, down from a prior 4%. Pretty much that was as good a report as you can get from a pure macro point of view, but arguably it was too good a report for equities and for risk appetite into the weekend, as markets aggressively pushed back their expectations for the Fed policy outlook, now not fully pricing the first 25 basis point cut until October. That's pushed back from June, where the pricing was pre-release, and also now pricing around 29 basis points worth of easing by the end of the year, and that's down from about 40 basis points before the payrolls figures dropped. I would just caveat that by saying that it does seem a little bit extreme and a little bit of an overreaction. Certainly the Fed will not be wanting to overreact to one single data point, but I think given the broader market mood, which is one of focusing on upside inflation risks, and of one where the market is really gunning for the long end of government fixed income curves, it was perhaps no surprise to see such an aggressive move on such a hot labour market report. And we did indeed see selling across the Treasury curve after that payrolls print, the 2-year yield rising by about 11 basis points, 10-year yields rising by about 7 basis points in the United States. And of course, while we're talking about fixed income, it's worth mentioning that the softness in gilts has continued into the new trading week. 10 and 30-year gilt yields rising by about 5 basis points apiece at the open this morning. 10-year yields touching 4.9% here in the UK. Nevertheless, back to Friday, it was also a weekday for equities, with the S&P losing around about 1.5%, the Nasdaq lurching lower to a similar degree, and futures for both indices trade lower to the tune of about 2/3 of 1% this this morning. Friday also saw the dollar jump higher after the blowout labour market report. The dollar index ending the day about 0.5% firmer, briefly trading north of the 110 figure after the print, and we have retested that handle this morning. Other G10s all losing ground. The euro testing the 102 figure to the downside. Cable dipping below 122, and this morning we got down to a low during the Asia session and the early part of the London session, that low in cable coming in around 120, 120. So still seeing that disconnect between sterling and gilts. We also saw a move higher in gold after the jobs number, which was perhaps a little bit surprising, but perhaps a reflection of upside inflation risks. Gold rallying about 1% on Friday, closing just shy of $2,700 an ounce. In terms of other bits and bobs from the back end of last week, it's just worth flagging the continued move higher that we see in crude prices, with WTI trading about 3.5% firmer on Friday to its highest level since October of 2024. Front Brent also reclaiming the $80 a barrel handle. This was after a whole bunch of sanctions that the US slapped on Russian oil firms, and I'm hoping that Ryan has got more information on that because I haven't actually written any notes on it. So I'll let him cover that momentarily.
Not that many notes. But...
Well, I've given you a 2-minute heads up to go and get some now.
Thanks.
In terms of other things from Friday, we also had employment data out of Canada, which itself was very, very firm indeed, with the Canadian economy adding almost 91,000 jobs in December, double the amount seen in November, while unemployment fell to 6.7%. For a prior 6.8%. That print, though, does have all the hallmarks of something that was skewed by seasonal hiring over December. So do just perhaps take that with a little bit of a pinch of salt. Speaking of Canada, in the least surprising news that you will hear today, former BOC and BOE Governor Mark Carney is set to announce his bid for the Liberal Party leadership and consequently the Canadian Prime Minister post sometime this week. That is according to sources cited by Bloomberg and by the CBC. And lastly, on Canada, they are, according to Bloomberg reports, plotting how they will retaliate if Trump begins a trade war with Canada. Of course, we are now just 1 week away from Inauguration Day next Monday. Canada have apparently put together a list of almost every product that the US exports to their northern neighbour. And basically, every product on that list could be the subject of tariffs. Canada aiming to go, and I quote here, dollar for dollar in terms of retaliation were tariffs to be imposed. Away from the United States, Bloomberg sources reported on Friday that the Bank of Japan, they are said to still be mulling their rate decision for January. Given that rate decision isn't until the back end of next week, this shouldn't really be too surprising that they haven't actually made up their mind yet. In fact, I'd be a little bit worried if they were. Nevertheless, the sources reports did tilt a little bit on the hawkish side. The BOJ said to be looking at raising their inflation forecast as a result of the moves in the yen, and also as a result of recent moves in rice prices. So we'll see whether or not there are any grains of truth in those stories. Here in the UK,
give me a break. It's Monday morning.
I'm on fire this morning. Here in the UK, are you still there, Ryan?
I am, unfortunately.
Oh, good. No, sorry. No, it's just you disappeared off my screen, sadly, but as long as you can hear me. Here in the UK, we had warnings from Centrica on Friday that gas reserves are, quote, concerningly low. Of course, everyone here will know how bloody cold it's been recently. UK gas storage is about half full at this moment in time, and that is about 26% lower than it was at this time last year. Nevertheless, the government's saying that they are confident we have enough gas and electricity capacity to get us through the winter. If that doesn't worry you, then
nothing scares you more than that,
right? Well, indeed. And last but by no means least, we had reports out of Deutsche Bank on Friday. They have changed their bonus structure so that now it will not only be focused on revenue, but it will also emphasize metrics like teamwork. What a load of rubbish that is.
What a load of crap.
Indeed. That's your lot from me for now.
Well, thank you for that. So, as I said before, no Zach today. So, but thankfully, Andrew Hart's awesome note is around, so I can get some out of that. But first off,
at least someone's working.
Exactly. It's not me. Big shout out firstly to our friends at CME. Just a quick update on their FedWatch page. We're currently pricing in unchanged at the next meeting, which I believe is in 16 days. Unchanged at 97%. Cut 25 is currently at 2.7%. Moving on with some headlines. So as Michael alluded to, oil extending gains for a third session on Monday. This is due to the sanctions that were announced over the weekend, affecting Russian crude exports to top buyers, China and India. These measures are targeting another 200 entities and individuals, ranging from traders and officials to insurance companies, as well as hundreds of oil tankers. That's why we're seeing a bit of a bid there. The guess being that China will actually have to buy legit crude for once. In US small cap names, the IWM down more than 10% from its November 25th high. That obviously equals a technical correction. The 200-day, which is where it bounced last August, that's 1.5% away. So no doubt there'll be some technicians keeping an eye on that number.
One thing that is interesting, sorry, just on the Russell, and actually I was talking about this with our good friend Michael Hewson last week. Obviously, we had this big rally after Trump came into office, and now the index is basically back where it was on election day. So it's quite a big sort of about turn that the small caps have done in the United States.
It's what's the moniker for it? Small craps rather than small caps. There's a lot of zombie firms in there. I think that's that.
Yes, that's very true.
Weighing down, isn't there?
Especially when tens are up 100 basis points or so.
Well, yeah, exactly. US dollar strength. Goldman Sachs upgraded its dollar view for the second time in 2 months, expecting it to climb by about 5% over the coming year. For Apple sold fewer iPhones and lost ground to Chinese rivals last year, reflecting the absence of Apple Intelligence in its largest market outside the US. The iPhone slipped to 18% of market share in 2024. That's according to Counterpoint. Rising
competition's taking a bite out of that, aren't they?
Oh God, make it stop. Rising bankruptcies suggest a potential widening of high yield spreads. The 12-week moving average on US bankruptcy filings is now at 17, the highest in 2 years. It's also in line with levels seen during the 2020 pandemic and the 2008 financial crisis. Myself and Michael did mention this last week about we could still be seeing some lag coming. Probably very likely we're still seeing some lag where companies that barely survived on the back of COVID handouts are now finally ticking off the register. So just wanted to keep an eye on there. China's CSI 300 off to its worst start of the year since 2016, although Goldman Sachs maintaining its overweight rating on A and H shares sees 20% growth, 20% gain, by the end of 2025. Good luck on that one. With China, well, only as we've said before, you just can't trust it. It's just it's not a 0% that it's a non-zero probability, that the Chinese government just say, no, these shares are mine now. Yes. That's always a concern. Sticking with China announced more tools to support its weak currency on Monday, unveiling plans to park more dollars in Hong Kong. And that would be to bolster the yuan and improve capital flows by allowing companies to borrow more overseas. China's exports gained momentum in December, with imports also showing recovery, though strength for the year end was part fueled by factories pushing inventory overseas as they brace for heightened trade risks under a Trump presidency. Myself and Michael have mentioned this many times. In fact, I believe, if my memory serves me correct, we even said in November, that, possibly even before Trump was elected, that should he get elected, we'll see a front running of possible tariffs and stuff. So ignore the December data. And that's kind of what we've got here. So
I think we did, and we don't get many things right, so we should milk that one as much as we can.
Oh, absolutely! I would like the gold star I'm giving myself is fucking massive. According to Bank of America, a study last year, 71% of US financial advisors have little to no gold allocation, and those that do often representing less than 1% of their portfolios. So that's one for the gold bugs. I suppose there's an argument that should they then decide to get involved, that's further fresh money coming to the market. Europe risks failing to meet its storage targets for next winter. This is further to what my good friend Michael was saying about Centrica's word of warning to the UK nat gas market. This sets the stage for one last scramble for supplies before new liquefied natural gas capacity starts to ease the situation next year. And I think we're already talking about next winter's storage, so it's never a good sign on that front. Although, let's be fair, I think just a sideline on this one, a lot of people have been comparing the nat gas storage figures to like things like the 5-year average. That's pretty unfair given the last 5 years have been predominantly kind of milder winters. So it's probably worth going back a little bit further than that. It's it makes a good headline that Europe's running out of gas. It's still got quite a lot, and there is more on the way. So I'm not buying too much into the scare stories on this just yet, but it is fucking cold outside. AI then data
Technical
centers.
term.
Well, yeah, put my hand out the window. There you go. AI data centers use of nuclear power has boosted prices of enriched uranium to a record $190 per separative work unit. That's a new unit for me. That was 56 3 years ago. That's according to the FT. So from 56 to 190, not too shabby. EU rates, I'm pretty sure Michael might have brushed on this, but ECB may cut rates further in order to boost growth and ensure it delivers on price stability mandate. That's gone to Lane. What else we got? Much of Germany's meat and dairy product exports outside the EU are no longer possible after the country's first case of foot and mouth was discovered on Friday, or confirmed on Friday. That's very bad news for Germany because they ain't got a lot going for them at the moment, and that's another nail in the coffin. Sticking with our European friends, well, friends in the EU at least, nationwide strike in protest against possible pension reforms have crippled air and rail traffic in Belgium on Monday. German sports car maker Porsche reported a 28% tumble in 2024 China sales on Monday as persistent weakness in the world's largest car market hit German car makers. Lithium prices are expected to stabilize in 2025 after 2 years of steep declines as shuttered mines and robust electric vehicle sales in China soak up an oversupply, although potential for mines to reopen may cap gains. That's according to analysts and traders. Taiwan Semiconductor Manufacturing Co., TSMC, the main global producer of advanced chips used in AI, is expected to report a 58% leap in fourth quarter profit on Thursday because of the surge in demand. Finally, two headlines with a geopolitical nature. Representatives of China's military will visit Japan mid-January as agreed by both countries. Well, that's handy. I'm guessing they would both need to agree that one to enhance mutual understanding and trust. That's according to the Chinese Defense Ministry. They reported that this morning. And Taiwan have charged I'll start again. Taiwanese charged with suspicion of spying on behalf of China rose by a third to 64 people last year, the island's National Security Bureau said, adding most were current or retired soldiers, which doesn't sound good. And that's it. Back to you in the studio.
Well, thank you very much, mate. In terms of the week ahead, then, well, starting with today, of course, you've already mentioned the data we had out of China overnight. That's pretty much it in terms of today's data docket. There's nothing else on it. There's no earnings of note, and the ECB speak that was scheduled from Chief Economist Lane and the Finnish member Ren, they've already made their remarks. So it could be something of a more subdued day ahead, at least in terms of data and potentially news flow. Although I would just caution, of course, that we are as I alluded to earlier, just about a week or so away now from Inauguration Day in the United States, and every man and their dog in the media is going to be trying to get sources, stories, and intel and supposed insight as to what the Trump administration is going to do once they come into office. So do bear in mind that there could be a bit of a sort of headline barrage as we move through the next week or so. In terms of scheduled events, though, for the coming week, tomorrow is also a relatively light day in terms of data, with just as the latest US PPI figures due. Wednesday, things are a little bit busier. We have CPI due from here in the UK, with headline inflation set to have held steady at 2.6% on an annual basis in December. Core and services inflation, they are seen slowing just a touch to 3.4% and 4.8% respectively. Also on Wednesday, we have CPI inflation figures due from the United States, which will likely be the final nail in the coffin of a January cut if that thing wasn't dead and buried already. Headline CPI, that's seen rising 2.9% on an annual basis in December, while core inflation is seen holding steady at 3.3%. Wednesday, also a busy day in terms of policy events, with the Fed's Barkin, Kashkari, Williams and Goolsbee all set to speak, as well as the Fed due to be releasing their latest beige book of anecdotal economic evidence. And Wednesday is also the start of fourth quarter earnings season on Wall Street. Before the open, we hear results from JP Morgan, Citi, Wells Fargo and Goldman Sachs. And of course, that kicks off earnings season, which will run for the next 3 or 4 weeks. Into Thursday, and arguably the most important release of the week is due, and that is the retail sales figures from the United States for December. Sales seem rising by 0.6% on the month, compared to the 0.7% rise that we saw in November. Thursday also brings our latest read on employment from Australia, GDP here in the UK, the monthly figure for November, and the US also gives us the latest fully fed manufacturing figures and the weekly jobless claims release, while bank earnings continue and actually conclude with Bank of America and Morgan Stanley on Thursday. And then last but by no means least, into Friday, it's another busy day of Chinese economic releases during the APAC session. We have fourth quarter GDP, industrial production and retail sales all due. Of course, most of that will be made up, so take it with a bucket full of salt. We also have the latest retail sales figures from here in the United Kingdom, housing starts, building permits and industrial production due from the United States as well. And lastly, it is just worth bearing in mind that Monday, the 20th of January, is a holiday in the United States. It is Martin Luther King Jr. Day, so we may see things quieten down a little bit earlier than usual on Friday as US participants jet off for their long weekend.
On Martin Luther King Day, again, this is very much old hat trading, kind of, just things that used to happen. We did back in the day during the floor. What was the whole theory, or kind of the whole kind of way of thinking about markets, where a lot of fresh money didn't come back into the market until after Martin Luther King Day. It's surprising how often our good friend Polemic Payne is a big fan of using that day as a kind of a potential for a turning point in markets. So one to keep an eye on, just looking back. Obviously, everything's changed in the recent years, as it's all gone electrified and all that stuff. But back in the day, it was something to keep an eye on, is marking the turn for markets. So just something to have on the radar.
That is a very good point, and you're right. It is kind of that
sorry,
2.5.
Sorry, whoa. Say that again.
I know. I'm not saying that again. It pains me every time I have to say it. But it is kind of that sort of 2.5 weeks into the year. All of the sort of noise is out of the way, and
exactly.
as you say, people kind of come back to a bit of a cleaner slate. So yeah, do obviously bear that one in mind.
Exactly. Cool. All right. Well, thank you, Mr. Michael Brown. Just quickly, we did mention about gold, so it's worth shouting out about CME's new, well, I don't think it's that new, but it's they've given it a bit of a push, the 1 ounce gold contracts and micro contract for gold. So if you are looking for something to trade without having to put a ton of margin, keep an eye out on that. I put it up in the old Jumbotron, or whatever we call it, up on the top of the Spaces session, so keep an eye on that, give that a read. But yeah, if you are trading today, keep it tight. Keep an eye out for Cam's crypto rundown, which should be coming along half an hour maybe. So big shout out to Cam, who's listening in at the top of the board. Hopefully Zach will be back tomorrow. But apart from that, if you are trading, keep it tight, and we will see you all tomorrow. Thank you very much. Bye.
Bye.